Assalamualaikum, dear students. I hope you are doing good. Did we met before in this class?
Yes, doctor.
Yes,
Okay,
Doctor.
that's
Last
great.
week.
That's great. So
Yeah.
we discussed all the basics.
Yes.
Today we will start the discussion on risk and return, which is the first chapter.
We didn't begin the chapter. We just
Yeah. Okay. So today we will, inshallah, begin the chapter number 1, which is basically risk and return.
Doctor,
Yes.
I see, Doctor, I see in the blackboard that each chapter names as risk 1, risk 2.
Yeah, that's the lecture 1, lecture 2, deliberately split it because they are lengthy. So we will split it into parts.
And each one, it's a separate chapter or?
No, it's a part of chapter. Risk 1, risk 2 means risk chapter 3 parts. Huh?
Okay.
So you can see the slides. Huh?
Yeah.
So today we will start our discussion with the basics of risk and return. And we will see what is return, what is risk, what is the relationship between risk and return, how to calculate return, and how to look at the historic risk and return with the help of a small exercise. So basically, you will see many of the times I will take this live class. Some of the times I will upload the recording beforehand, and you will go through recording, and then when you will come the class, we will discuss the concept, and we will sort out the problems. And before this, I need to discuss with you that tomorrow, not tomorrow, it's on Tuesday, 3 p.m., you people have a meeting with the Pearson team. Pearson team will introduce you about the Pearson platform, and they will share you all the information how to use the Pearson platform, how to use the electronic book, electronic platform, how to create your account, and how to attend the quizzes and other things. Huh? So you have to attend that Pearson meeting 3 on Tuesday, and the recording will be also provided to you later on, but in the meeting you can ask them many questions and other things. Huh? And after, once you are used to with that meeting, once you are comfortable with that meeting, then you will purchase the Pearson book for this course. And there will be other students also in the meeting, senior students. They will be attending the meeting for other books, but they will provide the general information, how to use any book, how to attend any practice sessions, how to attend any quizzes and assignments using the platform. So the whole exercise is just because you are going to use it in the coming days. So please do not forget to attend that meeting. Yes, any question?
Doctor, do you know the price of the book?
Last year it was something between 150 to 200 real for each book, but it keep on changing. I'm not sure. It will be like that. It will be not
It's
different.
around from 100 to 200.
Yeah, in between that, it stays like this for, but
Oh.
it depends upon book to book. The future next classes, maybe some book will be 220 or 250, something like that, but it's like this, 150 to 200, something like this.
Okay.
For each book. But this semester you have only one book. Next semester maybe you have to buy 2 books. After that, I don't know. Every semester, whatever books are available on platforms, we are shifting on platform now.
Oh, okay.
Okay, so the risk and return, and the relationship between risk and return, and the how to calculate this return and risk, and historic risk and return relationship. This is the discussion for today. First of all, we need to discuss the return, and this return or financial return, we need to discuss a little bit in detail with its calculations. One thing, whenever we talk about return, one thing you need to keep in your mind, that when you talk about accounting, you talk about profit and loss. Profit and loss is one thing, and return is another thing which we use in finance. So basically, you can say it's return is basically profit and loss in terms of finance. When we talk about finance, especially when we talk about the investment, we talk about return. We don't talk about profit and loss just like we used to talk in accounting or some other areas. So what is the difference between a profit and loss and a return? This is the point of discussion. So ideally speaking, when you do any type of investment in finance, for example, you buy a stock. When you buy a stock, there is a chance that stock price will increase. Okay. At the same time, there is a chance that stock will also give you a dividend. Okay. So there are two parts of that investments which you are looking for. One part is relating to your capital gain. One part is relating to your capital gain or loss. When price will increase or price will decrease, you will have either capital gain or capital loss, whatever we call it. Huh? And when the stock will give you dividend, you will earn some yield. Dividend is yield. So when we say return, return is both of it, yield part and capital gain and loss part. Collectively, we call them as a return. So whenever we do some sort of investments in finance, we are looking at two parts of that investment. One is the capital gain or loss part, and one is the yield part. Collectively, we call them as a return. So return can be positive, return can be negative. If you have capital gain and yield is also giving you positive dividend, then you will say I have a positive return. And otherwise, you have a negative return when instead of capital gain, the share price go down. Then you may have a chance of negative return. Similarly, let's say you invest in bonds. When you invest in bonds, there is a chance that the price of bond may go up. And when the price of bond will go up, there is also a chance that bond will pay you. Do bond pay you some dividends? What we receive on bonds? We receive on bonds coupon. Bond will pay you coupon. Huh? So the price change of bond and coupon collectively, we call them, we got some return. If price change is positive, you will get a positive return. If price change is negative, you will get a negative return. So it's just like what we call profit and loss, but it's more like a finance term where we cover two things, capital gain and loss and the yield. Let's say you make another investment. You make a real estate investment. In real estate investment, there are again two chances. Real estate prices may go up. When prices may go up, you may earn some difference of prices as a return, as a capital gain and loss. A price may go down. Instead of capital gain, you will have a capital loss. And what type of yield the real estate investment give you? What is the yield on real estate investment?
I guess selling it on cheaper price.
No, selling price is capital gain or loss. The yield part.
It depends, the selling price.
No, selling price, if selling price is positive, your capital gain.
Yes,
if selling
if it's
price
loss,
is negative, you have capital loss. This is capital gain or loss part. Yield part. Yield part.
Is the property itself?
Yield part is not a property. Yield part is a rent. Rent.
Oh, okay.
Real estate will give you ijar. Stocks will give you dividend. Bond will give you coupon. Property will give you rent. You can rent a property. capital gain and loss is the change, fluctuation in price. And yield part is what you are getting out of that investment on a regular basis, dividend, coupon, rent. For example, you invest in a gold. Is there two parts?
Yeah, you might rent it. Might rent the good itself, so it becomes yield.
Okay. No, I was talking about gold. Gold.
Ah, gold. I
That's
think.
gold.
Oh,
No,
thought it
capital
was.
gain.
No, no. Yes, what?
Capital gain.
It's a
Capital
Because
gain is there.
yeah.
Capital gain is there. But is there any yield part?
No,
Normally
cannot-
on commodities,
unless you are renting your
yes,
gold.
unless you are renting, which is a rare opportunity. On the commodities, normally yield part is zero, huh? But we say it's
Yes.
zero. But every time we make an investment, we are looking at two parts, the capital gain and loss part and the yield part. So collectively, these two parts, we call them return. So return is a broader term. It's not just like profit and loss. Profit and loss, your company make profit or your company make loss. When we talk about return, we talk about investments. Huh? Whenever we make investments, investments can give us capital gain and loss, plus investments can give us some yield. Collectively, these two parts, what we call is the return. The collectively these two parts, when we talk about them, we said we have return, positive return or negative return. When collectively the positive return, we said it's positive return. When collectively we are in a loss, we said it's negative return this time. Investments can go positive, investments can go negative. So components of return are two components, yield component and capital gain component. Now until ever, for whenever you are in finance, especially the investment course, whenever we are talking about investments, we will talk about return. We will not talk about profit and loss from investments. Huh? So whenever we will talk about investments, we said we got some return, no profit and loss. This is not a proper term to be used for investment. And mostly in finance, we talk about return from an investment, return from a particular venture. Okay, any question?
Doctor,
Yes.
until now, I didn't understand what does it mean, yield?
Yield is that regular cash flow which you are receiving, the regular cash flow or income which you are receiving from any investment. For example, you invest in a bond, it pay you coupon. You invest in dividend, you invest on property, it gave you rent, a car. Huh? That is a regular income which you are receiving from investment. We call it yield. And price change up and down is capital gain. Collectively, these two make the return of any investment. Do you understand?
So when we say capital gain, is that prices increase?
Price increase or decrease? If decrease, capital loss.
Okay, I understand now. Doctor, just one more question.
Yes.
The yield, is it something you get it by repeatedly? For example, that you every month, if you have
every month, every quarter, every year.
For example, if you have a bond, every month they give you a coupon.
Coupon, yes.
Okay.
Yes, that is yield.
Okay.
Okay, if let's say if you invest in cattle, you know cattle?
No.
Commodity
Yes.
investment.
Yes,
Cows. What is the yield and what is the capital gain or loss?
Is it from the production of the cow?
Yes. If there's a milk cows,
Yeah.
every time you will sell their milk and it's a yield part. And when in the end you will try to sell the cow as a whole, its price may go up and go down.
Yeah.
So,
Doctor, I have a question.
yes, please.
In this part,
Yes.
if we collect all the yield,
Yes.
it will make a capital gain. So can we call it in this part capital gain?
No. If you collect the yield, what do you mean by that?
Like for example, the cow milk.
Yes.
Selling the cow milk to other markets,
Yes.
it's gonna make a return,
Yes.
either positive or negative.
Yes.
So in this case, it will be capital gain.
See, capital gain is when you will sell the cow itself. There will be some.
But also you can generate money from the yield.
Yeah, yield is regular income, huh? You will keep on adding it, and in the end, you will keep add the price of the cow from loss. If from price you get loss or you get gain, then you will add both of them to get one thing, which is return, huh? So both are part of return. If I'm not wrong, I'm getting your question that sometimes you don't receive the yield on regular. For example, you tell the bondholder, I will not take the regular coupon, you will give me in the end, huh? So if he will pay you coupon in the end, still for that return there are two parts, the yield part and the capital gain part. Why we keep them separate? Because there are a lot of calculation where we need to look at both. There are a lot of investments where we need to compare both, and then we need to decide that which of the investment is better for us and which of the investment is not better for us, which of the investment we are going to invest, which of the investment we are not going to invest, because we need to compare both things. So that's why we keep both things separate. We don't need to mix them. We add them and we say it's a collective return. But at times we need to separately look at both things to make some decision. So that's why we keep looking at them separately also, but collectively it's a return. It's also fine. We'll take some examples. Don't worry. Let's take some examples. Okay, sometimes we are also interested to look at the relative return. Relative return is the difference between absolute return achieved by investment and the return achieved by the benchmark. For example, you make an investment in a stock. Let's say you make Aramco stock investment, and Aramco stock give you a return of 10% in a year. Okay. Now, are you interested in this 10% interest return from Aramco stock? Is it a good return?
Not bad, but it depends.
Not too much.
About Doctor, what you invest.
You receive
the amount that you invest in. Sometimes 10% it may be a large number.
Okay.
All about the shares.
Okay. See, if I tell you that the entire market return in this year, the entire market average return of whole Tadawul this year is 5% because it was a bad year, COVID year. Now, the Aramco return is good or bad?
Yes, sure, good.
Very good.
Now it is very good. So
it's above than the average.
Yeah, idea is we never look the returns in absolute sense. We look return and compare it with benchmarks. We always compare the returns with benchmarks. So the difference now of these two return is 5%. 5% positive difference. This is your relative return. Your relative return is 5%. That means your return is higher than the average market return or higher than the benchmark return. So every time we look at the return, we look at the relative returns for the investments. If I tell you that the bonds of a company, Tesla, give a return of 10%, okay, and I ask you, is it a good return or not a good return? It's not a point to decide. You check the overall bond market. If overall bond market return is 20%, then Tesla didn't perform very well. Tesla return was less, huh? So your relative return in this case is minus 10%, which is not good.
Teacher?
Yes.
So we have to compare the performance of the company with the performance of the index of all the market, right?
Yes. We not lazim all the market. We always keep benchmarks. So it is, whenever we are investing, before that, we need to set a benchmark. And then we need to decide the investment performance in comparison with benchmark. Without benchmark, there's nothing.
Is the benchmarking is the index of the stock
most
of
of
the market?
Most of the cases, it is like that, but not in all the cases.
All right.
Not in all the cases. We will tell you why not in all the cases, but it is too early to talk about it because you will study whole of the chapters about benchmarks in your investment course. So sometimes we take the average. This is the simplest way, the average market return. But there are many other things, many other factors due to which we don't use it all the time. But
Doctor,
yes.
Is the benchmark like the average, but not for all the companies?
Not all the time. It's like average, but not for all the time we use this as a benchmark. Sometimes we have to use, for example, now we are talking about the average Tadawul return. Average Tadawul return is 5%, huh? And the Aramco return is 10%.
10%.
Looks good. But average return of all the oil markets, all the oil companies, only oil companies, is 12%. Now Aramco return is good?
No.
No,
not good.
No,
We change the
because
benchmark.
it's -2.
-2.
No, because we changed the benchmark. So this benchmark was a good benchmark to measure the Aramco performance.
So, Doctor, we are comparing with the sectors, huh?
Sector to sector now, huh? So it's not lazim that we always keep the benchmark as a whole market. Sometimes we do sector, sometimes we do other countries, same companies. The
Yes.
real estate companies benchmark in Saudi Arabia, real estate companies benchmark in UAE. Why not? Sometimes it depends upon our investment horizon. There are many, many complex things in it. I don't want to discuss all of them right now. But remember what is important now, we never see the return in absolute terms. We always see the return with comparison to a benchmark. Okay? And that is what we call the relative return.
Okay, we always compare it to the benchmark.
Yes. We always take this example. We already took this example. Now, what is risk? Variation. If we are not able to meet the benchmark was, let's say, 15%, and we got only 12%. Okay. Next year, we get 18%. Okay. After third year, we get only 6%. See, there's a lot of variation in the return. The more the variation, the more the risk is. The less variation, less the risk is. Huh? So higher variation create more risk. Low variation create less risk. Variation, variability. It's varying. It's not very stable. It's unstable. Variation is high. This is what we call the risk. There are many definitions of risk. It's the variability between the expected and actual return. You was expecting a return of 15%, and this time return is 12. Okay. Next time it go higher than 12. Okay, you are happy. Third time it go much less than 15. You are very, very, very annoyed. So a variation between the expected return and actual return. What was you expecting and what actually you got? The variation is called the risk. There are many definitions of risk. Sometimes we say uncertainty. We are not sure what will happen. This is a risk. Many of the companies in different parts of the world are uncertain about their return due to COVID. This is a risk. Huh? They are facing a risk. Huh? So it is uncertainty of outcome. It's the variation of outcomes. If there is some chance of potential loss, if we believe we might lose, there's a chance of loss, potential loss, we say still this investment is risky. So many, many factors are there, many, many issues are there, which we need to look at when we are looking at the risk. Anyways, this is just a definition. When we say the relationship between risk and return, there's always a trade-off. Trade-off means if we are willing to take a high risk, we are expecting high return. If we are willing to take low risk, we expect low return. There's no one-way scenario. If we are expecting high risk, we are also expecting high return. If we are not expecting high risk, we are not expecting high return. So this is also risk and return trade-off. Dollar profit and loss. First of all, we need to look at the return, how we calculate return. Then we will talk about risk, how we calculate risk. But in finance, we are more interested. We are more interested in numbers. Simply, if we know what is return and what is risk is not enough in finance. What is important in finance to reach at the numbers and to make the decision. And this is what we do all the time. First of all, let's see what is profit and loss. We know dollar profit and loss is what? It is the ending value plus distributions minus original value or original cost. And when we say the rate of return is the dollar profit and loss divided by the original cost. When we divide it with the original cost, you may be wondering what I'm doing, but we'll take an example, then it will be more clear. So we are always looking at the rate of return. Rate of return is something which we are looking for. So it's the dollar profit and loss divided by the original cost. This is what we call the rate of return. But again, if we are talking about this rate of return, more technically speaking, we call this as a holding period return. The time we hold an investment. So this ordinary rate of return is basically holding period return. We call it HPR. Many of the time in finance, you will see HPR. HPR is the holding period return. How much time you hold one investment. So holding period return is same like rate of return. What is this holding period return? We will see again. So holding period return, we can replace it with this dollar profit and loss. We know dollar profit and loss is ending value plus distribution minus original cost. So instead of writing dollar profit and loss, we can say holding period return is ending price plus distribution minus beginning price divided by beginning price, or beginning price, original cost. Anything which is used in your book or any other books is the same thing. Now let's take the example and then it will be more. Yes, please.
What's the concept, the main concept of HPR? It's like
I'm going to give you this concept through an example. It's better we take the example. Okay. Let's say there's one investor, Alice. He bought some gold coins for 1,000 and sold them 4 months later for 1,200. Okay, this is one investor. The other investor is Mark. Mark, on the other hand, he bought 100 shares for $10 each share and sold those shares 2 years after for $12 per share. Okay, and in between, once he received a dividend of 0.50, $0.50 dividend he received for 1 year. Okay. Calculate the dollar profit and loss and percentage return earned by each investor over the respective holding period. Okay, so first of all, profit and loss, what we call dollar profit and loss. LS dollar profit and loss for the first investor is very simple. The ending value plus, minus the
original cost.
So his dollar profit and loss is 200. And how we calculate this holding period return, we know the dollar profit and loss divided by the original cost. This 200 divided by the original cost was 1,000. So his holding period return is 20%. His return for that period was 20%. Very simple to calculate. For the other investor, second investor, Mark, he invested in stocks. So his ending value plus distributions, if he receives some dividend. So ending value for one share was 12 multiplied by the number of shares, okay, plus he received 50 cents as a distribution, as a dividend multiplied by number of shares, minus the original cost, the price at which he buy the share, 10 multiplied by the number of shares. So when we make all these calculations, his profit and loss was 250, but we are interested to calculate the holding period return. So 250 divided by the original cost, his original cost 10 multiplied by 100 was same 1,000. He got a return of 25%. So The return of the first investment is 20%. The return of the second investment is 25%. Or in more appropriate way, I will say the calculation is very easy, so I'm not focusing on it. What is more important to discuss the idea. If I say the holding period return of Alice was 20 and holding period return of Mark was 25, which investment is better?
Mark.
Mark.
Yeah.
It looks
Yes.
like that. But there is one more concern. See, how much time Alice invested? How much time he invested?
Oh, Alice 4 months, but
4
Mark
months.
2
Mark,
months. 2 years, yeah.
2 years. So every time they both returns are not comparable. They are not comparable. We can't compare them because one investment is only for 4 months and other investment is for
2 years.
2 years. So we cannot say the LS is better or Mark is better unless we make the things annualized. We need to standardize things, or for standardization, it's always we annualize, we make the things annual. Do you understand?
Yeah, every year. Annual.
Yes.
So it's not a good way to, if I ask Alice, what was your return? And she will explain me, I make a return of 20% on the 4 months of investment. And I ask Mark and he will tell me that I make a return of 25% on 2 years investment. It's too bad to explain it like that. So always when we ask each other about the investment return, they tell us one number, which is we understand by default annual numbers. So we need to convert these numbers into annual numbers. Without that, it is not good. So what we do, we need to convert these numbers into annual numbers again. So we know for LS, the holding period return was 20%. So when we need to convert it annual numbers, APR, we call it annual percentage return. Annual percentage return is holding period return divided by N period. So his holding period return is 20% divided by period. Its period is only 0.33. How? 4 divided by 12. 4
Yes.
months divided by 12. 0.33. So his annual percentage return is 60%. Now for Mark, holding period return divided by N. 0.50 divided by 2. 2 is because 2 years, 24 divided by 12. It will be 2. So his annual percentage return is 12%. See, totally upside down.
Yeah.
Alice is much better than Mark because now we talk about annualized things, annualized standardized things. If I ask one student, let's say, what is your overall performance in the last semester? And he started telling me, I got this much marks in this subject, this much mark in this subject, this much mark in this subject. And then the second will tell me, I got this much marks in this subject, this much marks in second subject. By the end, I will feel myself crazy. The best thing is you tell me GPA. It's easy to compare. Similarly, it's not good to look at the holding period returns when periods are different. So we need to look at the APR. APR, standardized things, annualized number. And even more better approach is to look at EAR, which you study already in the interest rate chapter. Effective annual rate. Effective annual rate. Effective annual rate is based on the compound interest formula. APR is based on the simple interest formula. Simple interest is rarely used, but annual interest, compound interest formula, very commonly used. Compound interest. You know what is the difference between simple interest and compound interest? Interest on interest is compound interest. Interest on interest is a compound interest. And simple interest is just simple interest, no interest on interest. So better approach is to use the compound interest formula. Compound interest formula says 1 plus HPR power 1 by N minus 1. Using the whole formula give us different EAR for LS, which is 74%. And if we plug in the same values, we will get 11.8% for the Mark. Now, This is even more better number. Although APR is good number, I will not say that is not annualized, but sometimes we are better to use the EAR formula. Effective annual rate formula will give us the more better understanding, which is based on the annualized percentage, effective annual rates. Effective annual rates are much better, much better. Okay, so
Which
after
one,
this
doctor?
discussion, which investment is better, LS or MARC?
Alice,
Why LS is better?
because
Because she
annually
did in
it
4
grows.
months
High return,
4 months.
High
more
return.
than the marks did in 2 years.
annualize high returns.
Yes.
Okay, so question, please, up to this point. Question.
Yeah. So we should EAR is more precise than APR.
EAR is more precise in finance. See, this is a big difference. 74 and 11% is a big difference. But sometimes in investments, we are facing such situations that point differences, only decimal point differences, very close. Huh? So EAR is better. It shows us very precise results.
So, Doctor, EAR is the most accurate.
Yes, it's the most accurate effective annual rate based on the compound interest rate formula.
Okay.
Effective and
Effective annual rate. Okay.
Okay.
Now, interestingly, we have to compare two investments. This is what we were talking about. We have to compare two investments. One is the Microsoft, one is the Walgreens, and we have to do it through the small mini scenario exercise. But before that, in these slides, what we learned about the return calculation, and we learned about the annualized return calculation. We don't know how to calculate the risk. For this purpose, we use standard deviation as a simple measure of calculating the risk. Standard deviation, do you know? Measure of dispersion from mathematics. Standard deviation, statistics.
Yes.
Standard deviation and variance. These are the measures of dispersion. So how they help us in finance? They are the basic things through which we look at the risk. Very basic. Although you will learn many good risk classification later on, even in this class and many other courses. This is the basic way to look at the risk. Very basic way. Okay. So let's look at it. We know this is the formula of variance. Variance, X minus the average whole square divided by n minus 1. This is the formula of variance. And when we take the under root thus of this variance, it becomes the standard deviation. We know these formulas. We know these basic formulas from our statistics course. So we will use it over here. Okay, now let's take a case, a small mini exercise. There are two companies. One company is Microsoft, and these are the Microsoft is a very famous company. We know them, huh? And these are the return of Microsoft. Microsoft return in from 2007 to 2012. Return every year. How much return Microsoft stock give us every year? These are the returns given. Okay. The first thing is we calculate the average return. Average return for Microsoft is 5.5%. From these 5 years, their average return is 5.5%. And Walgreens is a company which sells the agriculture sort of instruments, agriculture pesticide sort of things. These are the return for the same years in for Walgreens, and this is the average return of Walgreens, 2.3%. I know it's very simple. You know how to calculate average. Nothing to worry about. Huh? So we need to compare and we need to discuss which company we should invest. Should we invest in Microsoft or should we invest in Walgreens? This is the point of concern for us. Should we invest in Microsoft or should we invest in Walgreens? Which company you will like to invest?
We need to use the rules for variance, then to see
standard deviation.
here still we didn't calculate variance. Up to this point, only average returns. So based on average returns, which company is better?
It looks like Microsoft is better than. Yeah.
Okay, the same thing in decimal. We don't, if you don't understand, don't look, no worries. Huh? It's the same thing given in decimals, easy to calculate in Excel. Okay, now the next thing is we need to calculate their variance. This is the return of Microsoft minus average return. We will get the deviation, and next step we will do the deviation square. Just to complete the steps. Huh? Otherwise, this can be done in Excel in one step, but it's a beginning class. So we are completing the steps. So what is this? This is X. This is X minus average. Huh?
X bar.
And next one, we take its square. It becomes the deviation square. This just like it is used in formula.
Doctor.
Yes.
Return is given here or not?
Return was given. Return was given.
Okay.
But I will give you some exercises where you will also calculate return anyways, but it is given over here. The next is for Walls-Green. We use the same method to calculate the deviation square for Walls-Greens. Okay, we have the deviation square. Next step, what we do, we take the sum of all the deviations. And the formula it is given sum of all the deviation X minus X bar square. This is what we are doing, taking sum of all the deviations over here for Walls-Green, over here for Microsoft. Okay, then we need to calculate variance. Variance is sum of all the deviation divided by n minus 1. You know it, huh?
Yeah, because it's a sum.
It's the formula.
Yes.
So these numbers divided by 6 minus 1, because we have 1, 2, 3, 4, 5, 6 years. 6 years. Huh? So these numbers divided by 6 minus 1. This is what we got as a variance. Sigma square. Sigma square. The variance for Walls-Green returns and the variance for Microsoft returns. Variance does not look a good number. So we take its under root to reach the standard deviation. Standard deviation is more standardized good number. So we take its under root and we got the standard deviation of 34 for Microsoft and standard deviation of 31 for Walls-Green. Now this standard deviation is a risk. Basically,
yes.
Standard deviation is a risk. Which company has high risk?
Microsoft.
Microsoft.
It has high return.
It has high return and high risk, huh?
Yes.
The other company?
Low return.
Low return.
Low return, low risk.
Okay. Which company you will invest?
Microsoft.
Walls-Greens.
Doctor, it depends on the person. If you know.
But apparently, which company looks better? Apparently.
Microsoft.
But their risks are very nearby, huh? Near. So why not go one more step? Coefficient of variance. Do you know coefficient of variance? CV is the standard deviation. Coefficient of variance is standard deviation divided by average.
Yes.
So when we do coefficient of variance for Microsoft is 6.2. Coefficient of variance for
13.5.
Walls-Green is 13.5. Okay. So what is this? Sorry. What is this? Coefficient of variance of Microsoft is less. Let's interpret how we interpret the coefficient of variance. For every 1 unit of return, how much risk you has to face?
6.2.
For every 1% return, how much risk you have to face?
13.5.
Oh, so low coefficient of variance is good because coefficient of variance is a standardized type of approach of looking at risk. For 1% of return, you are going to face 6.2 units of risk. For 1% of return, you are going to face 13.5 units of risk. Low units of risk are better for us. For 1%, same return, high risk and high, here it is low risk. So this way we reach to a conclusion that this company is better, because for 1% of risk, for 1% of return, we are supposed to face, or we are supposed to expose to low units of risk. Do you understand?
Yeah.
Yes.
So
Yes.
going one more step, make our decision more easy. More easy. Now it is not depending upon person to person. Now it is very clear. Do you understand?
Yes.
Yes.
Okay. So this is how we sometimes look at the risk and return. Today, up to this point, we learned only few things. What is return? It is not profit and loss. It's a finance term, it's an investment term. It has two parts, yield part and capital gain and loss part. Return can be positive, return can be negative. Second thing what we learn is the relative return. Relative return is a term when we compare the return with a benchmark. Benchmark can be different for different types of investment. We set different benchmarks depending upon the nature of investment, depending upon the situation, we set a different benchmarks. Okay, then we learned what is risk. Risk is a variation. Risk is a variability. Risk is when there is an uncertainty of outcome. Risk is when there is a chances of potential loss. We say it's a risk. Then we looked at the calculation of return. Then we look at the calculation of simplest return is the holding period return. Then we say, no, holding period return is not good. It's not comparable between two investments when the investments having different periods. So we need to use APR. APR is good, but APR is based on the simple interest formula. The best way is to look at the EAR, effective annual return. It will give us even the minor difference between two investments. It will separate them. EAR is based on the compound interest formula. It's a much better approach. Then later on, we said how to measure the risk. Instead of measuring the risk with any complex calculation so far, we said, okay, simplest way to look at the risk is to look at the standard deviation. Then we used this small simulation exercise, small exercise, to look at the risk and return of two different companies. And then we see the risk and return approach of two different companies. And in the end, we use the coefficient of variance, which is the relationship between the risk and return. And we see the lowest coefficient of variance is better. The coefficient of variance tell us for 1 unit of return how much risk we have to face. So we said the lowest is better. And so risk per unit of return on investment, what we call is the coefficient of variance, is lowest is better. Okay, up to this point, you have any question? Any question?
Yeah, Doctor.
Yes.
Doctor, about there are now 2% that or two things that show us the risk. First one, the standard deviation, yes?
Yes.
And the second one, the coefficient of variance.
Okay, the difference between standard deviation and coefficient of variance is that standard deviation is only risk. Coefficient of variation is the relationship of risk and return. It's the ratio of risk and return. For one return, this much risk. For one return, 13% risk for Walgreen. For 1% return, 6.2 units of risk for the Microsoft. It's the relationship of risk and return. It's not simply risk. Huh?
Okay.
Relationship.
So it's depend on the percentage that you have.
Yes.
The return that you have.
Yes. It's the relationship.
And the coefficient of variance, if the percentage is low, then it's the better.
It's the better.
And the standard deviation is.
It's also low is better, but sometimes see both of them are very close. We are not decisive, huh?
Yes.
So then we use the relationship and make the things more clear. Khalas?
Doctor.
Yes.
As an investor, I will use standard deviation or coefficient of variance.
You should use all of them to make decision. Don't stop.
Then how?
First, look at the average, then look at the standard deviation, then calculate the coefficient of variance, and based on the coefficient of variance, decide.
Oh, okay. Thank you.
rules. Yes, please question.
Doctor, can you go back 2 or 3 slides?
Yes. This one?
One more.
Okay.
Yeah, here. Or no, one more.
Okay, no problem.
Yeah, here in the formula that we have distribution. So what's it mean? Distribution of what?
Yield. Distribution of bond is coupon. Distribution of stock is dividend. Distribution of property, real estate is rent. Yield. Huh?
So in the
another
question
name.
here.
Another name.
Okay, so the question here that they purchased or take 100 shares. Okay.
Yes.
For every share, they took this 0.5. So
dividend.
So this 0.5 is the dividend.
Yes.
Okay.
Okay.
And okay.
Doctor, about the standard deviation and the coefficient of variance.
Yes.
Standard deviation, it's the relationship of risk only.
It's only risk. It's not a relationship. It's a risk.
It's the risk.
It's a standard form of risk.
Yeah, and the coefficient is risk and return.
It's the relationship between
the relationship.
two.
Okay.
Okay. Rule number 1. If faced with 2 investment choices having the same return, select the one with the lower expected risk. If the return is same, select that which is having low risk. Understand? If the return is same for 2 investments, which one you will select?
If they give me the same accepted returns, I choose the lower risk.
Low risk. If having similar risk, select the one with the higher return. If risk is same, now which you will select?
A higher accepted.
The higher
return. Understandable. But sometimes both the risk and return levels are different. Then it depends upon the tolerance level of the investor. If investor is a risk-averse investor, he don't like risk, he will select the low risk, low return investment. But if the investor is a high risk loving investor, he will select the high risk and high return investment. If the risk and return levels are different, then it depends upon the investor, the tolerance level, the attitude of investor. Some investors are risk lovers, they like risk, they like to take risk. Some investors are not risk lover, they are called risk averse. They don't like investment with high risks, so they are happy with the low return. So which one you will choose, A or B?
A.
Why? Same return?
Yeah,
but low risk.
Same return, but low risk.
In this case, C or D?
D.
C.
No, I think C.
C.
C, yes.
D.
Doctor.
Why?
More accepted return.
And
more
the same
return,
risk.
but same risk, huh?
Yes.
Same risk, yes.
Same risk.
And in this case?
Yeah, of course, C.
L.
Or it depends.
L, doctor.
On the person.
All, doctor.
It's
No,
depend.
it depends upon the person. No,
yes.
If you are risk averse, if you are risk, you don't like
And the
risk,
higher
you will say
return.
L. If you like risk, you will say S, huh? Purely
Yes.
on the attitude of the investor, because they are different in level now. They are different in level. Do you understand?
Yes.
Yes. Clear.
So these are just beginnings, rules of risk and return. We talked about risk and return, basic things. This is it for today. Next class, we will go one step further and we'll see the future risk and return. This is something which is past. Microsoft and Walgreens, which is past. Future, we need to look at the different considerations. Huh? Any question from today's lecture, feel free to ask me.
Thank you, doctor.
Thank you, doctor.
Tuesday at 3 p.m. you have a Pearson meeting. I will share with you the link on Blackboard. You will click that link, and 3 you will join with Pearson. You can ask them questions. They will tell you how to use the platform, how to buy the book, how to register, how to create your own login, how to do quizzes, how to attempt the practice exercises, and how to solve the what you call assignments. So please be there, and inshallah we will meet. I'll also try to be there at that time, but it's basically for students, huh? So you need to be there with the Pearson and learn from them how to use, and they will also share with you video tutorials and many other things and many stuff which will help you how to use this Pearson platform. This semester we will use it definitely. All the material will be there, all the exams and quizzes will be there. Next semester you will have to use it for 2-3 courses, so better you learn it once, huh? Thank you very much. If there is no more questions, see you inshallah.
Doctor?
Yes, please.
Doctor, what time you say?
3 p.m.
3 p.m. Okay.
Today, doctor, right?
Tuesday.
Tuesday.
Yes. Okay. Thank you very much.
Thank you, doctor.
See you inshallah.
Hopefully. Bye-bye.